Morning, Carl Peter.
Morning, Stephen. Good to see you.
Yes, likewise. So here we are at episode 5 of Giving Wealth Purpose. I think when we started off, our first episode was kind of beyond the balance sheet. Just what does that mean around giving wealth purpose? Then we moved on to the concept of retiring, but retiring to what? What does that actually mean beyond the numbers? Then something quite topical, as the world was in war in the Middle East, to talk about signals and noises, and what are important things to be looking at, and what is just noise. Then we went into estate planning, why we think most estate plans fail. And so today, I think it's quite apt, given that kind of background, to kind of talk about the cost of complexity. So, Carl Peter, what does that actually mean?
Yeah, good question. And I think probably the best way to explain what the cost of complexity means is via a client example. And actually, this happens to us more than we actually realize. So by way of example, we had a prospective client come and see us a few months ago. Very successful in life and in business. On the face of it, had been doing all the right things for the best part of the last 20, 25 years. But once we started to unpack sort of what they'd done, you began to get the sense that the situation could only be described as something you'd call a financial smorgasbord of, a whole bunch of different stuff going on. So, for example, they had preservation funds, set up that dated back more than 15 years ago when they left a job. Had different investment accounts with different platforms and providers. I think we counted something like 5 platforms, 8 or 9 different investment accounts, spanning the whole works. There was a family trust that dated back many years, and I think the trust deed was last updated in something like 2012. And when we asked, what was the purpose of the trust, what assets the trust held, wasn't quite sure, other than to say thought there was some kind of property in the trust. There were some, offshore investments that hadn't been looked at for a while. There was, a whole bunch of stuff in terms of existing products, living annuities, retirement annuities, tax-free savings accounts, across the works. And what made it even more interesting, that there wasn't just, one advisor he'd been dealing with. There were 3 advisors registered across, various of these different, financial products. One of which he hadn't spoke to in a number of years. So I guess when we, asked him the question, what's the strategy and the purpose that underpins all of this, he couldn't really give an answer. Over the best part of the last 15, 20 years, he'd done all the right things, invested in products, in funds, etc., local, offshore. So an accumulation of decisions that seemed, good decisions at the time. But when you look at it all now in terms of, how does it all tie in together in terms of a plan, a strategy relative to what you're trying to achieve, he didn't really have an answer. And that's what we mean about the cost of complexity. You think you've done all the right things over a number of years, over time, but actually once you step back and look at everything now from a strategic level, does everything you put in place now, still make sense? Is it serving you? How does it, fit into the overall plan? And many times, clients and people we speak to, they can't actually answer that. So that's kind of a good explanation, and which is actually, something that we see often, and happens more than we think in our industry. I mean, just anything you want to add to that?
Well, I mean, the picture of a smorgasbord. I mean, that I think of a nice smorgasbord of some nice meats and cheese platters, and those seem quite nice. But I mean, this seems like a bit of a nightmare to kind of deal with. But like, how do you think that complexity actually accumulates? Because I think people have good intentions; they kind of do the right things at the right time. There's topical stuff. There's things that are popular at the time, but yeah, how do you think this actually accumulates?
Well, it's it's one, what you think good decision at the time based on the information that you have. So you accumulate all these things over a number of years, thinking you're making good decisions as you move along, but there's no clear coordinated strategy that kind of underpins all of that. And I think that's probably the biggest reason for this unnecessary complexity that accumulates. When there's no strategy that underpins what somebody's trying to achieve, often then, like we, see with case of multiple advisors, who's coordinating all of that? So having somebody to coordinate the strategy, be clear on the plan that's clearly set and defined to, your goals and what you're trying to achieve for yourself and your family, that's super important. So when you have all these incremental ad hoc, bits and pieces that you've, put together over the years, like you say, with good intentions, but not underpinned by clear strategy and plan, that then creates this, smorgasbord of all this stuff going on, which, it seemed good at the time, but looking at it now, well, is it actually still serving you, and that's something one then needs to kind of reflect on and look at, and reevaluate, particularly, in our case when, when we work with clients like that.
I mean, so what you're saying is, along the years, some those things made sense and they ticked a box and they served a purpose, but really, I guess the challenge is that coordination problem.
Exactly that. Exactly that.
Okay, Carl Peter. So we were speaking about the coordination problem, and maybe you can elaborate a little bit more on what that actually means.
Yeah, so I mean, I think in our world, that means a couple of things. So often we see, people look at their, their finances, their tax affairs, their structures, in silos. So you might have your financial advisor, financial planner, like we alluded to now, often more than one, looking at, certain parts of your balance sheet, your retirement savings and investments, and maybe other savings or investments. You might then have your tax consultant, or accountant who's doing your, your finances and your books, looking at things, in an isolated perspective as well. And then potentially even people that help you with your structuring and trust structures, and, whether that's, attorneys helping with that, trustees, doing their own thing. So often clients are working in silos with their different professional advisors, but nobody's really coordinating and talking to each other in terms of, what's the real strategy and purpose behind all of this? What's ultimately, trying to be achieved here? And how's that, solved for? And I know, we've got some good client examples that you can allude to, where we see that happen in practice, and ultimately, how we think that it ends up costing clients, rather than actually, enabling and helping the strategy.
Mm. Yeah, you're absolutely right there. In terms of that sort of silo approach and isolation, investments put in place. At some point, clients might have felt that they need to have a trust. And so off they go to the lawyers or the trust experts in, the early 2000s, and a trust gets set up. Maybe they move an asset or two in there. They look at their trustees. Quite often they use their accountants to be the independent trustees. And, up until recently, we didn't need to have an independent trustee. And so some don't even have that independent trustee. But there's kind of a blurred line between, the trustees and the accountants. And yeah, I mean, we've been doing a big focus around estate planning and sort of looking at trusts deeply. And, things have changed. Legislation's changed. Section 7C in terms of loans changed. Beneficial ownership registers, asset registers. And those things haven't been updated along the times. And clients feel that they have these accountants, and I'm not bashing accountants, I'm just saying, they do the accounting role. But quite often they don't drive the management of the trust. They just act as that independent third-party trustee. And so no one's actually kind of driving that. And then kind of looking to understand if that trust and the strategy and the investments in the trust still make sense in terms of what the family's trying to achieve. There might have been changes in the family, moving abroad. We see a lot of those, with tax laws changing abroad in the UK, and suddenly being a beneficiary of an offshore trust and being a UK tax resident is becoming problematic. And so you have this legislative change, whether it be from an admin point of view or from a tax point of view, and just seems like nobody's kind of driving that whole holistic picture. And that's just an example of just trusts. We find that with a whole lot of other things, investment wrappers, life cover, and other types of investments. We, in our family office space, we use these analogies of being like this helicopter pilot. And the visual that we have there is really this helicopter that's hovering over the intersection of where life, business, local trusts, offshore trusts, family meet. And when one thing changes in one of those areas, it's kind of trying to see what the effect has on other aspects. So that's quite an important thing. It's, that kind of question of like, who's looking at things holistically?
Mm. Yeah, and I guess, if we step back and we kind of ask that question, why is it often the case, and why has that happened? Whether it's, multiple advisors, professionals working in silos, I guess the sense that we get often when we speak to people, because a lot of our industry, particularly on the financial advice and financial planning side, is very much, product driven. From that perspective, so somebody might have started off young, been sold some kind of, whether it's a risk or investment product, and not, forgotten about it, not looked at that for many years. Then as they evolve in their business or career, then, they maybe have some more needs that need to be addressed, maybe something, offshore investing or whatever, potentially find another advisor to do that. But again, very transactional, very much, product driven. And then, on the side, they're talking to, their tax specialists or accountants and talking about, putting together, trust structures or whatever that might be that they think makes sense for their family. And I think that there's potentially been an inherent, I guess, you could call it lack of trust, because when you feel like, people are, always trying to, I guess, sell you something, it kind of makes you more reluctant to want to, share everything and share your broader concerns, share your broader visions, in terms of ultimately what you want to achieve. And that's why you have all these sort of isolated silos of products, investments, tax wrappers, trusts, whatever the case is, with no kind of clear, defined, coordinated strategy. And to your point, somebody that sits at the top as that helicopter pilot that kind of oversees all of that. And I think that's the challenge in our industry. It's about, okay, well, how does one remove that inherent conflict of interest? So, clients and families are then, willing to open up and share all of that with you, so that one can serve as that strategic advisor or, helicopter pilot.
I mean, I guess there's two things I'm curious about now, and the first one, do you think this is a lack of a skill of certain financial advisors? And I'm going to elaborate on what I mean by that now with example, or do you think it's an incentive issue? Because from the skill point of view, I mean, we've come across many clients that, arrive at our doorstep asking around some offshore structuring and offshore advice. And they tell us they do have advisors, local advisors, but their advisors don't know about their offshore investments. Now, my mind, it's like, their tax implications, their estate planning implications. How does your South African advisor not know about it? Now, I don't know if that, is historically driven because, people were sort of on the lowdown to talk about their offshore investments from a, government tax type of thing. Maybe it's that, or it's a skill set. Or we find clients have share portfolios and quite considerable balance sheets and numbers in those share portfolios, which could really be used to supplement their income in a tax efficient way using the dividends. But there's again no coordination. How do you have an asset allocation discussion with a family when they have a big portion of equities sitting in a custody account, share portfolio account, and we're not taking that into account? Or concentration levels, or working for a big corporate, I think of financial services, and have a big portion of company shares, that are sort of stuck in one industry or sector, and they're not having that discussion with their portfolio manager to say, well, maybe in the rest of the portfolio, we should reduce our exposure to financials. We see that. And then obviously with the ability to invest offshore locally, using these online platforms, investing directly offshore, there are implications in terms of, CITES and death taxes that somebody's not looking after. So I wonder if it's a skill thing. Is it a trust issue? Or is it an incentive issue?
Yeah, good point. And I think there's there's probably an element in all of the above. From my own example, when I worked offshore for offshore companies, advising only on offshore investments, often to South African clients, and they would have a South African advisor, but that South African advisor knew nothing about the offshore investment side. So to your point, if you're an advisor that doesn't understand the whole client picture, that potentially has implications and second order effects around things like estate planning implications. If that isn't taken into account, all those things that people don't necessarily think about beyond just the, what the purposes of this investment is. And then likewise, it's become so easy now with these online platforms, whether it's, easy equities or interactive brokers or, any stockbroking account now. You can, set up an account in 5 minutes, get your money in there, start buying ETFs and shares in, all the best companies and exchange providers in the world. But you're not, again, necessarily thinking of the second order effects of, okay, whoops, suddenly I own more than $60,000 worth of US listed financial products, whether it's a US listed ETF or shares in companies like Microsoft and Amazon, all those big names. Suddenly you've got a real CITES tax problem, and people aren't aware of that kind of thing. So on the one hand, this financial democratization that's taken place that, we ultimately think is a good thing. People are more informed, more knowledgeable. It's easier to invest than ever. That's great. But there are always, from a planning perspective, there are always consequences, so not necessarily having somebody that, understands, the full picture, that can tie all those threads together for you, so that forms part of a coordinated strategy, makes sure that you understand the risks of, holding things the way you are potentially, can have, massive, have massive implications. And we do see that, happening more and more. And then I think, on your final point around financial incentives, I guess as long as our industry model is built on having to sell, financial products. People have sales targets, all those kinds of things. They want to get to the fastest, easiest way potentially to sell a financial product, and aren't always then considering the structuring implications. And we've seen that again recently in a few examples with clients with, we're talking big balance sheets here. All the investments, local, offshore, set up in their own names, no thought given to any kind of tax efficient structuring. And you look at, okay, well, what's the plan here in terms of, it's one thing putting together an investment portfolio, but it's also got to be done with some thought in terms of, what's the strategy, the long-term succession planning behind this, who's going to inherit these funds when you're no longer around, how's all of that managed? So there's a lot more to a conversation often than just looking at, okay, well, what's the next best investment idea? So that, there are a lot of moving parts around all of that. And people don't, always fully appreciate all of that. And that's where having that, I guess, coordinated view and somebody who's looking at the big picture for you, we think becomes super important.
I mean, I find it quite interestingly, the rise of these social media finfluencers, and they kind of show two strategies, one without an advice fee and one with an advice fee. And very easy to show that the one without the advice fee, puts you in a better position. I mean, that's quite obvious. There's an extra layer there. But I guess what you're trying to say now is, the value of advice is not necessarily linked to, putting in a product. That's a means to an end. It's how you got to making sure that that product is still suitable for you and serves a need in an overall coherent strategy. That's the value of advice.
Exactly that. With all the implications around, what are the tax implications here? What are the estate planning implications?
So, Carl Peter, if we think about that coordination problem, what are the types of questions that we should be asking, perhaps annually?
Yeah, so I think there's a few key things that's worth checking in on and asking yourself on a regular basis as to, what makes sense here. So, in terms of any structures that I do have, is it actually solving, for a key problem? Or is it just there kind of for the sake of it? Have any tax laws changed or evolved that update and affect anything that I have in place? As we touched on, things around trust laws and tax laws, and the tax laws that that impact trusts are evolving at a rapid rate. So you think you've got a robust trust deed, but the deed was last updated 10 years ago, and your beneficial ownership registers haven't been updated, your asset registers, all those kinds of things. So it's making sure you stay up to date with with all of that in terms of making sure that's still relevant. Do you want to add a couple there?
Yeah, I suppose another just, tax or product legislative changes, whether it be something, the taxation inside funds, they've changed over the years. On a product level, there was a certain offshore wrapper that used to have these reinsurance agreements, and they were sort of, effectively tax-free. SARS changed the definition of that and sort of created tax implications. So there are certainly things that are changing. I guess like one sort of key point or question we ask our clients regularly is, explain to us how the structure works and how it benefits you. And I think it's a key important part that the families actually understand what everything's doing, rather than, I don't know, it was just at the time it was a good thing. In instances like that, then we're going to dig deeper, we're going to scratch deeper, and try to understand that.
Exactly that. And then it's just, what gaps are we not seeing today? Because we know things are evolving fast. Are there any gaps that have been created that we're not seeing that we need to take into account? And does this still serve me today? All the stuff that I've done, put in place, does it actually serve me? Does it actually get me where I want to go? And does it all form part of a coordinated strategy? Because, like we said, every product ticked a box at the time, but does it still make sense today? And that's what we need to confirm.
So, Kopita, I alluded to one of the sort of possible causes for this cost of complexity, and that being the incentive trap or the incentive issue. We want to talk a little bit more about that and expand on that, what we mean by that.
Yeah, so I guess, in our industry in particular, increasing complexity and incentives are almost tied, hand in hand. Because when incentive structures are tied to the fact that, being sold more, continuously adding, building products on top of products, which offers different channels of, potential sources of, commissions and fees to the relevant parties, whether it's advisors or, accountants and all the rest of it. You do have to kind of question that kind of incentive structure and how aligned it actually is into serving clients and their best interests. I mean, we know, if we look at, the investment and advice industry, you've got platform fees, you've got fund fees, then you've got advice fees, then you've got potentially, fees for structures. Increasingly, what we're seeing now as well, more advisors are kind of launching their own, funds in terms of, quasi asset managers. So they might take an asset management fee from the fund, et cetera, et cetera. So, you've got all these potential layers that can add unnecessary complexity without necessarily adding commensurate value. And we find that somewhat problematic, and maybe you can explain why and why we think that.
Well, I think, traditionally advisors only get paid when they sell your product. And so if they're not selling you products, they're not earning additional income. I guess there's a margin squeeze, in terms of advice businesses. And to your point, has opened up that opportunity for advisors to be creating their own model portfolios and, earning additional fees on there. Even sort of trying to sound like sophisticated by selling structured notes. Now, don't get me wrong, there's a place for structured notes. Quite often, though, sold on fear about uncorrelated market returns, etc., etc. But the reality is there's a big fee baked in there that's probably not even disclosed. And so I guess when you're aligning incentives, with being paid more by having to sell products, then you're going to have that inherent conflict. And I guess that's something that, in our business, we've sort of been quite deliberate about trying to prove or avoid.
No, exactly. I mean, we've tried to adopt the approach very much around our advice, and the fee that we charge clients is a function of, how complexity their situation is, really around, your goals, your needs, your existing product structure, where you want to be, because that directly impacts the amount of time, that we spend with clients. So, let's be clear here, we've got nothing against, people being paid well, being paid fairly, for the work that they're doing. But I guess largely in the industry with the current incentive structures, there is no correlation. There's a total mismatch. It really is all about, accumulating assets. And then, with that percentage model, the correlation between, output and work and fees generated, often, makes no sense whatsoever. And we've got some real recent examples of this where we've seen advice fees, just the advice fees on clients, slot in at between, $500,000 to not far off R1,000,000 a year. So you can imagine, the size of a client's balance sheet to be generating that kind of advice fee. Now, the problem, as we see it with that, is how are you demonstrating your value add relative to that advice fee in terms of, your output, the advice that you're giving, etc. Essentially based on one annual review a year, and I'm sure there's some stuff going, on in the background, but kind of translate that into an hourly rate and see, how that makes no sense whatsoever. And the rest is just a function of markets that, we have no control over, So that's why we've, try to take this approach around, flat fees and trying to remove that conflict of interest where we don't actually have to sell a product to make money. We're there to help create the strategy, design the strategy. Some of that might involve helping put investments in place and structures or whatever, but there's got to be some kind of correlation between output and actually time spent on clients. Obviously, both, client-facing time, but also, there's the research element and all the other things that you do in the background as well that needs to be factored in. But there's got to be some kind of, in our view, correlation there, which, clearly isn't the case now. And that's our view. People might disagree.
Well, I think, I'll challenge you on that a little bit. It's not so much, us talking about a flat fee versus an assets under management model. It's not about that. How you charge your fees is probably more irrelevant. It's about how you demonstrate the value that you're adding, So if you want to convert that to a percentage of assets under management, but you can you can demonstrate that value, and it's that's okay. Quite often we find that's not the case. That example that you shared, the close to R1,000,000 fee, one, that client was not even aware of the fee they were paying, and two, they were all just hidden in products. A client with that size balance sheet needs a lot more sophisticated structuring. We saw none of that. And so that's the thing that that our model kind of aims to solve for. We talk about wanting to look at a client's whole balance sheet. And I guess, it talks into this sort of complexity discussion. When maybe a question you can ask yourself is, when last has your advisor told you to remove something out of your product set?
Yeah, exactly. And I guess the question is now, with someone of that size balance sheet, why wasn't more time spent on, trying to get the structures right? And people automatically think, with structures that has to add complexity. Ultimately, it's not there to add complexity. It's there to create efficiency for not just now, but for later, what comes next in terms of next generational planning, etc. So those are the kinds of important things to get right up front before you even start to think about, how you invest that kind of money. So, and maybe making an assumption here, but because the need now is to try and start earning an income as soon as possible by getting clients into financial products so they can start earning their advice fee, that is maybe why, there's the shortcut on not spending time on thinking through, the bigger strategy around, what structures and, things make sense first before the investment conversations get had and what investments are needed to underpin that, because it takes time. And if people feel they're not kind of getting paid until they sell the investment, again, potential conflict of interest there, and are clients, real needs being met? So that's also something, I guess something to think about. And maybe just to, clarify, Stephen, that when we say, we talk about complexity and what it means. People assume certain things, let's say whether it's setting up a family trust or offshore trust or, whatever the case is, or, certain other solutions and structures, automatically assume that that's unnecessary complexity. But in some case, that's actually not. It's actually there to simplify and make things more efficient. Because if you're looking at the consequences of not doing that down the line, that's where the real complexity and potential hurdles and stumbling blocks come in.
Yeah, absolutely. I mean, I know sometimes complexity can sound like sophistication. And I think, like, by and large, our approach is always trying to, like, follow that KISS principle, keep it simple, stupid. But sometimes you say, like you mentioned, sometimes a family's balance sheet warrants that, additional complexity, and not for the sake of being complex and to walk around and say, I have, this, trust to offshore trust investment and structure, and I have these offshore trustees, and it's not about walking around with that type of ego. um we spend a lot of time with our clients trying to understand what money means to them, and the sacrifice and the value behind money, and what this wealth represents to the family. A lot of times these families this generation are not going to run out of money. They've got that mindset, or the balance sheet is big enough. So it's really about giving wealth purpose. And when we start digging deep into giving wealth purpose, and we're talking about not just this generation, but generations to come, that's where we start having those conversations around, where that complexity comes in. So it's not about complexity just for the sake of complexity, but again, everything has to have a purpose. And every member in the family needs to understand why we've put certain things in place. And we need to question regularly whether that still makes sense and what are the implications, because we know that change is the only constant, and we need to keep up to date with that and relevant. So, Peter, I want to talk about the hidden costs of complexity. Complexity has these silent costs, and most people really get to add those costs up. What do you think we mean by that? And maybe talk about the financial cost.
Yeah, so I mean, when it comes to, I guess, investing, financial planning, and structuring, in our industry, it's kind of being aware of all the potential layers of fees that adds, whether it's through an investment where you might have platform fees, fund management fees, etc. It's understanding the different layers of product fees associated to different kinds of financial products. If you're using things like trust structures, it's the setup fees, the ongoing fees, the accounting fees, your regulatory fees, and all of those. So all these different products, solutions, investments, structures all have their own layers of costs, which of course, number one, add up, and number two, can add a meaningful layer of cost on top of of what you're doing or would ordinarily do. So it's not to say that sometimes these costs and fees aren't necessary, but depending on your situation, your complexity, your goals and your objectives, it's really being clear about understanding what they are, what purpose they serve, and ultimately, do they enhance your structure and get you closer to where you want to be efficiently, or do they detract from that? So somebody, for example, who has 100 million rand balance sheet, and it makes sense for them to have things like trust structures, and they need more sophisticated kind of ongoing tax reporting, might have multiple investment solutions. You look at all the fees involved there, it might make sense relative to making sure that the next generation, the family's going to be okay, their assets are protected, the implications of that, things like mitigating estate duty and the tax savings there, removing the need for executors, and then you weigh up the value that you gain by putting these things in place against the cost. And sometimes, that there is a really good argument for that, and it makes sense. In other instances, and we touched on this earlier, it comes across as clever of, the latest thing was, let's set up a trust, let's do this, let's try this fancy investment, and, have all these different parts that have accumulated with no coherent strategy. And if you actually look at, what a family or an individual needs, they don't need half of that stuff, so it's getting rid of actually what isn't needed. But first you need to actually fully understand, okay, what's the goal here? What's the purpose? And how do, these investments, these structures, whatever the case is, serve that bigger purpose? And then, and in many cases, simple, easy, low cost is going to be the most effective option. So I guess the point is there isn't kind of a one size fits all here. It really is, whether you get your thoughts, really dependent on, each individual, each family and their objectives and needs.
Yeah, 100%. I mean, just about every single family we work with has been sold some product or structure by a slick suited bank, private banker somewhere along the line, and it sounded great, and it was a really great presentation, a great story. Very rarely do they kind of understand why they're in those structures and what it means to them. We tell our clients often in our discussions around investment returns matter, that they matter, because obviously that's what gets you ahead in life. And investment returns are a combination of obviously the underlying return and the cost factor. There's no way around getting around certain costs, but we have to start adding them all up, whether you say it's, the platform, the investment advisor, the asset manager, the structuring, the trustee, the accountant, in the example of a trust, there's all those layers of costs. Somebody the other day asked a question around why should they pay for trust administration advice? They want to pay that fee, whatever the amount was. And, our answer was, what do you pay in bank fees? Do you question your bank fee? Like, some of the banks, 750 Rand a month in bank fees. And so there are some inevitable costs, but I think you hit it on the nail. It's really, not taking a blanket approach, but actually looking at each particular family, their set of circumstances, what's important to them, what they're trying to achieve, and trying to make sense if this adds to that or not. We've taken clients out of trust structures, trustee fees. Sometimes, like in international trusts, for example, we find that, while those numbers might be big in Rand terms, they're, quite small comparative in dollar terms for those trustees or investment advisors. And they don't kind of get the attention that they should be getting, and they kind of get a half-baked solution. No one really cares. It's a distant trustee, an investment advisor. And, just the costs just ramp up, and they're not really getting value out of that. And so, someone who does need a simple structure, we would always advocate for that, simplicity. So I guess the key sort of asset test there is about, do you understand every single structure that you've got in place and product and why you have it? And to your point, these products might be expensive, these structures might be expensive, but when you weigh in the saving of executors' fees, whether estate duties, just the ease of administration to transfer assets to your loved ones, the effect that it has on your local estate wrapping up process, capital gains, taxation at 12% in a hard currency versus potentially 18% in your own personal capacity in rands. You got to weigh those sort of things up and actually kind of look at the rands and cents of it and evaluate it on that. It's the same kind of discussion we have with clients not wanting to make changes to portfolios because of the fear of capital gains tax. When we actually start working out what that implication is as a percentage of the value of their assets, we find it's sometimes less than 2%. And we all know the market can give you that in a day. And so it's about kind of framing, not taking blanket rules, but looking at each client at their own merits. And again, we like to think our process talks to this because we look at clients' whole balance sheet. We're not incentivized to be selling products. So we like to think we take it slowly and we build it from the bottom up.
Yeah, exactly. We sit on the same side of the table of clients. We can discuss the entire balance sheet. It's not just about the areas we can make money off of, which then allows us to kind of look at that bigger strategic view. What makes sense? What doesn't? It's different for everybody, so that we can come up with a real strategy for a family, for clients that makes sense and works for them. And that we can only, assess when we work with people and go into that level of detail. So I think you summed that up nicely there.
So, Kopita, in the next section, we want to talk about what we call the 5 decision framework. And because I guess not all complexity is bad, I guess it's about questioning each layer in our structures and complexity and trying to make sense of that. And so we kind of developed a bit of a framework that we look at, and kind of goes loosely. It's a sort of 5-question framework, and it kind of goes loosely around, number 1, what problem is the structure solving for? And so if you can't name it on the problem, then you probably need to question the structure.
Yeah, exactly that. Then the next one, and probably the obvious one, is, okay, what does this all cost and in total? Clearly you've got the direct costs and the monetary costs from, direct fees, whether it's investments and, et cetera, or whatever that might be. Compliance costs, in terms of running this, what are the obvious compliance costs involved? How much additional time is this do I need to spend on this? And then it's also that, it's that mental load. So often it's not just the financial or monetary implications. It's really thinking about, is this going to cost me a lot of time? And what kind of mental load or potential stress does this additionally add? So those are often things that also need to be considered, because, when you're adding complexity, you don't want it to create unnecessary stress, add significant time, or create mental stress or pressure for yourself unnecessarily. That's not the point.
And then number 3, it's kind of like, what risk does this structure reduce? And I think there, one needs to be quite specific. And if you can't answer that, then again, you got to question the structure. And those kind of risks might be things like taxation. There might be creditors. There might be risk of, family merging through money, whatever that may be. I think you've got to be very clear about what it is that the structure solves. And if you can't answer for any of those, then, maybe a good time to be questioning the structures that you've put in place.
Exactly. And then the opposite side of that is, what potential risks does this now create? You've got things like potential compliance burdens, you've got governance requirements, potentially things like concentration risks, and complexity itself. So, coming back to the trust example, it might seem like a good idea on paper, but when you look at the implications of not only just, setting up a trust is easy, but managing that trust effectively in today's environment, where you need independent trustees, you need resolutions for all decisions that are made, you need up-to-date asset registers, beneficial ownerships. Things have to be done, really properly and by the book, which a lot of people today don't realize. So you might be adding risk to your complexity without even realizing it. So you really have to also understand the implications of what you're doing and why, and go in with all eyes open. Sometimes it makes sense, and other times, it might not.
I mean, that's kind of a great point. Especially with the change in the regulation that we've seen over the last few years in Trust Property Control Act and the requirements that SARS has. You can outsource a lot of that stuff. I mean, you have to know what it is that you need to do and how to be compliant, and you can outsource that. But I guess that's where you start looking at all those different cost levels, and I guess it comes back to understanding whether it's worth it. We've seen some trust structures that have a small amount of assets in those trust structures, and if you start adding up all these costs, then we might question whether they actually still worth it. Obviously, the greater assets, the greater risk that you have to lose something, well, it might justify those costs, but certainly something important to look at. And then I guess the sort of big question that we always look at is like, whatever structures you've got in place, if would you still be putting those structures in place today? Is it still valid today? And I guess, that's something to kind of unpack. And, if the answer is no, then one has to have a serious look at the structures going forward and whether you should get out of them or not.
No, exactly that. So it really is understanding, okay, what is necessary today for you, your life, your purpose, your strategy, where you're trying to get to, and what's actually, unnecessary. So wealth can, like we said, legitimately require things like trust structures, whether it's local and offshore or offshore, company structures, all those kinds of things. There might be a case for it. But it's really understanding whether that is needed and whether it is necessary or not. Because the goal isn't simplicity for its own sake. It's just having a coordinated, coherent strategy with everything serving a clearly defined underlying purpose. So it's intentional, it's understood, and it's earning its keep. So complexity is only justified really when it's solving a problem that you actually ultimately have.
Mm. I mean, and you talk about that coherence. I guess, how do we know that we've had a successful engagement? It's we like to call that the relief of the coherence. So, when we've sat with a client and we've had 15 different investment structures whittled down to 3, maybe having 3 advisors to the family down to 1. Yeah, that's a nice place. When our clients after our engagements have said that they've really valued us being involved in their lives, and it's been a great experience because things now make sense. It's simple. They're able to kind of draw it onto one piece of paper. And there might be some complexity in there, but they understand every moving part in their whole balance sheet and family structure. And they're making it simple for the people to, that they leave behind. I think that's a very important part. Quite often we have these patriarchs or matriarchs have got these complicated structures that only they understand. And, when we chat to them and, kind of ask them, like, what are their concerns of financial planning? It's very rarely that they say they need investment help, in terms of asset allocation structures. I mean, they have an idea and they're open to suggestions. But probably one of the higher ranking kind of concerns is like, I'm worried that should something happen to me, that my significant other wouldn't know where to start. And that is already, that's a key kind of sign for me that, that they don't have that simple, coherent plan with its complexity built inside.
Okay, so I think we've done pretty well. We've covered a lot of ground for today. So I guess just to kind of leave you with a few closing thoughts to tie all these different threads together. So, what does good actually look like? Number one, every structure has a clear purpose. You can explain in one sentence. All the costs are clear, known, and justified. The whole picture can be seen, ideally on one page, sometimes easier said than done. Ideally, somebody is watching over the whole thing and stress testing it annually with the assumptions and all those things that are built in. And I guess most importantly, your family can navigate this with you when you no longer around or when you're no longer there to guide the process. So really, coherence isn't about having less. It's about understanding what you have ultimately and why.
Mm. Yeah, so I guess this is what we would like to leave you with. Every product that you have or structure, somewhere along the line ticked a box and it made sense. Your retirement annuity, your trust structure, your company, your endowment, your offshore trust. Somebody sold it to you because it solved a problem. But life changes, legislation changes, we have tax changes, and goals change as well. And the problem is that structures don't update themselves. So the question is not really whether you have an offshore trust or a trust or an endowment or a unit trust. I guess the question is really who's ensuring that this still all fits together and still makes sense for you. So who's watching the whole picture? Because if the answer is nobody, it's not a fault of an advisor. It's just a gap that you need to fill.